This is Justin Pulitzer. This is my weekend review video for Sunday, May 17th, 2015. A lot to cover as usual, so going to just jump right in. So you can see on Friday here, we closed up near the range high, and it sort of was a bit of a lackluster day. I think a lot of people after this day thought that the next day here was going to be this real strong move up. And I was sort of not as convinced. I had discussed on the stream that I thought it would actually just be a choppy inside day, and that turned out to be correct. But let's take a look at what the move up might look like and what a move down might look like. So I've been discussing that I thought that if the market moves up, it may want to move up to one of these Fibonacci extensions, depending on what time frame you measure it on. It would be 213.40 or 214.17, which you could see isn't a lot higher and is actually consistent with what happened the last time we broke out of range. It was just sort of this middling move higher and then low conviction and then rolled over mid to mid range. So maybe we see something like that again and then a rollover to mid range. If we do get some type of a real blow off, you can see there's plenty of room till the channel high, which if it happened tomorrow, which I would likely say is not happening, we'd get it up to 218. However, I think this type of a scenario is more likely given the pattern that the market has, abided by lately. If we do wind up moving down, I would say that the first target here would be to fill this gap here down to like the 210s, and then potentially a move down to the 50-day moving average, which is roughly at 208.92 currently, and you can see that roughly coincides as well with the beginning of the upper distribution that I've been discussing, being the most bullish over 211.27, putting new all-time highs into play. If this happened to fail, I would think that we would see the 100-day moving average very quickly, and if we lose these lows, we could come down further into range to the 206.42 to 205.38. That, to me, would be typical price action for what we've seen. You can see that's what it did the last few times. Here we had a bit of a higher low. It's been holding the 100-day moving average. The 100-day is very important in my view. So that's what I'm seeing with SPY. IWM, on the other hand, is showing a lot of relative weakness. You can see we're not up by the highs. There isn't a ton of volume distribution above us, but I highlighted in this box there are some dead bodies. And the rally here is kind of stalled there. It stalled on the backside of this 50-day moving average after we cracked this up channel. Now, I don't necessarily know if this is going to roll over and be totally bearish, but I am saying that there is a lot of relative weakness, and it does have some room that it needs to work into. Maybe it does break in and get somewhere halfway into range. Anyhow, if we hold over the 120.97, I'd say the market is still quote-unquote healthy and buy the dip. If we lose that, I think we're going to see this somewhere between this 119.39 and the infamous, on this broadcast, 117.37, which was the sort of the line of unsustainability. Anytime we got over there in the past, it was a failure. Now that we're sustainably over there, I would think that that would be the support. If that happens to not hold and we lose it, and we're talking on a much further out time frame, I could see a move back to the 61.8 fib, and also which coincides with the real true trend line here down in the 112s. I'm not necessarily making that call, but I'm not necessarily not making that call. It's possible that this does happen if there's some type of a larger summer rollover correction. You can see we're starting to look a little bit head and shoulders here, a lower high, the larger head, and maybe we make a right shoulder here. So keep that in mind if there is some type of weakness in IWM and we start losing this 120.97, that there could be a larger summer correction ahead. Qs have been relatively weak compared to the S&Ps just because we're not up at the highs, but it's not all super-duper bearish either. We are making a higher high than this potential also head and shoulders type of pattern, which is sort of being negated here, although Friday's close was a little weak. So as a rule, let's use this 109.42 as the first sort of line in the sand. If that's lost, then I would say, we have to be on guard because we're moving back down and there could be some type of like a test of the 50-day moving average. But you can see there's a lot of confluence events down here when you start getting into like this 103s to 106 area, there's a lot of price, I guess, memory down there. So a move down might be begrudging after it kind of gets into this range, but it could get to that range rather quickly if this area here is lost, particularly the 50-day moving average again. So I'm sort of on cautious mode. Let's keep this chart in mind when I discuss Apple and Google, which I'm going to get to shortly. So one of the culprits here for the weakness in the market has been the TLT. And I had said that I was looking for it. It was starting to make a measured move and time-wise getting into some retracements that I saw as being key. And I did a measured move, and I said that this like $15.53 measured move, which was the same as this, that would roughly take the take TLT down to 117.30. Now, we did not get there. We rallied off of a 1.272 fib extension on this move and have bounced back up after a break here of a tertiary trend line. So this is sort of in this choppy, I guess, area, and it's below this swing low. So anything below this swing low and really the 2009 crash peak of 123.15 to me is still vulnerable for still lower prices. Now, I think that this rally sort of came off of a poor low. There's no excess. You can see there's no like bottoming tail, and it just sort of rejected back higher. So I'm a little bit suspect of the rally. I really would have liked to have seen it complete the measured move, maybe get the channel low or a confluence with the 61.8 Fibonacci retracement, and then rally up higher for something a little bit more sustainable. This to me looks like it may want to rally a little more and then roll over or maybe just chop for a while. So that will affect the market. Remember, higher interest rates are bearish for stock prices. Lower interest rates are good for stock prices. I think a lot of this has been on Fed rhetoric and the fear that the Fed is going to raise interest rates. I actually just wrote an article for a publication that should be out sometime this week or maybe later next week, which details a little bit about my views on the Fed. But you can see if they are true to form, they should be really lowering rates and easing. We've had weak durable goods. We've had weak and declining GDP numbers. The unemployment numbers I don't think are particularly encouraging, although the top line rate is low. The labor participation rate is the lowest since 1978, and the list can go on. So the real impetus for higher rates, to me, I'm not really seeing it. I think we're just going to have this kind of slow chop, maybe rising. But you can see we are starting to trade a little bit like a biotech stock here in U.S. Treasuries, which volatility in Treasuries could eventually lead to volatility in the stock market. So I am being very cautious. There's also been declining breadth. In equities, I've also discussed that the MOC orders have been to the sell side for a month straight, with Friday being the big exception with about 600 million to buy. And even so, that sort of paired off rather quickly since there wasn't like some super-duper spike into the close. Oil, which had been something that the Fed had used and said was one of the reasons for some of the recent economic improvement, or I don't know what they're seeing, but they seem to think that any of the economic improvement lately has been attributed to oil. So now that pattern is starting to reverse. And anything, in my view, above 54.24 puts higher prices into play. There may be some type of a rollover and retest, but oil may want to do, in my estimation, to come back and retest the 38.2 Fibonacci retracement, which is 67s, and potentially, I think, back up to 75s, which I actually do think will happen. You can see that would be a 50% retracement of the entire move, really where the big breakdown took place, and I think that would put some pressure on, I guess, the retail names as well as the restaurant stocks. So keep the oil chart in mind. This is also playing out in IBB. This has been the biotechs. This has been relatively weak also. Slightly lower low, making lower highs, a bit of a snap of trend. The 50-day moving average, though, in this is very key, and you can see we lost it, retested, spent a little bit of time below, but prices decided they wanted to go higher. However, we are on the backside of this sort of channel within a channel, and if that fails, there could be some weakness down to retest these lows, maybe to retest this volume distribution in this sort of mid-range here, and potentially the channel low, which would coincide roughly with some of these lows down here closer to 300. So I am keeping that in mind with IBB. This is also one of the reasons why I've been a little bit cautious in biotech, although I have been bullish in Gilead, and I'll discuss that in a, you know what, let's discuss that now. You could take a look at Biogen. This also, I'm just going to go through the list of them, and I'll probably end on Gilead since that's sort of the one I like. You can see that Biogen had that blow off. It's been making a series of lower lows and lower highs, and now we're sort of just on the downtrend line. So this is a really key area for Biogen. I was really looking for it for here. See, it rallied off of a less secure anchor here. I was really looking for it to do something like fill the gap here and then have the rally. And I think the reason the rally has sort of been, I guess, limp is that we didn't get that full extension down, and now we may wind up coming back down. If that does happen, I don't necessarily know if this area is going to be as strong as it might have been this time since it's so close to here, and there may be a further push into the middle of the range. That said, anywhere for right or right out play, somewhere between 349 and 358 here really should be the hold if biotech is going to stay strong. CELG is another one. Again, lower highs, lower lows, and now we're right on the downtrend line and the 50-day moving average. This really needs to break. If it can break, then I think we can start retesting some of these highs. If it rolls back over, then I think it's going to come back down. Also, may want to come down and retest this breakout point if there's some type of a further correction. I was really looking for this as a buy. I still am, somewhere between 100 and this 96.44, which was the breakout. You can see there's there's on different time frames, there's a 50% fib here. On this time frame, there's a 61.8. So I do think that pocket of, let's say, $4 or so is going to be a great right or right out buy point for CELG for some type of a bounce. Not necessarily an investment, but a bounce. Gilead. I have been bullish on this stock since they reported earnings. I like this move. It sort of failed and rolled over again during the week. I had discussed a right or right out play at 100 on the stream and with a few people, and you can see that worked. There was a gap and go here, but the little concern for me is that if you look off this day, you have 1, 2, 3, 4, 5, 6 days of rally. So it's getting a little bit steep and extended, and it's also coming into some reference resistance here. There was a gap fill here. The 110.44 was a reference breakout before a rollover here, and it's also getting to be mid-channel here. I kind of artificially drew in a channel. I do think at some point Gilead works its way back up to the old highs, which is in the 116s, potentially higher for the channel. But I would be more of a buy the dip than chase here, particularly after so many days up, just because if this does wind up rolling over, will you say you have good trade location buying here? And how confident are you going to be if this does roll back over to like 105 or 103? You're probably going to be pretty nervous. So my theory on all of these stocks is just buy the dips, don't chase the rips. So anyway, that's biotech as I see it. Let's talk about tech and let's talk about Apple. So Apple has been rather, I would say, weak since their earnings report. They had a gap in the after hours, which had gotten up to the channel highs, and then it just rolled over and has been selling off and has been sort of middling and weak. And I guess it's sort of had some breakdowns above and below the 50-day and the 20-day moving averages. I still think Apple really needs to clear this 129.85. I know I sound like a broken record, but that really was the spike high in the pre-market when it was added to the Dow Jones Industrial Average, and I think anything below there is a little bit weak. I would actually prefer to buy Apple either at the lower end of the range and near these reference lows here, like the 121s, 122s, or if it could get a little bit lower, or if that coincides with the channel by the time it gets there. I think that the channel will be some good right or right out type of action. Support, you can see it did fail a little here in terms of it did look over, but I do believe that that area will be something for a right or right out type of a play for anyone who has missed Apple. As far as right here, it just is chop and it's in the middle of a range, and I don't think there's really any, bias. I mean, you could see we are starting to change the pattern a little bit, although it hasn't confirmed. we were making lower highs and lower lows. Here it's starting to make a little bit of a higher low and a higher high. So if Apple can kind of get in gear and get back up to the highs, I think that'll do a lot to power the broad market. Google, which is also a big NASDAQ Q's component, is not doing anything really to help the matter, and it's also been in a range. You can see we have 3 highs up here, a couple of lows, actually 3 lows down here, and now it's sort of just middling in the range and kind of bouncing between these necklines and reference highs that I had discussed, the 544.41 and the 553. So I think anything below this 50 and 200-day moving average confluence is, to me, a little bit more bearish. If we can get a back above there, then I think the play will be bullish. You can kind of play on a break and hold for maybe a move back up into range. But here, really no edge. I had been looking for this to come back down and test into this like 525, 513 area. You can see, again, rallied ahead of time prematurely, and that's been, I think, part of the reason for the weakness in Google. So notice the constant theme here. This has been a theme for me for a while about these premature rallies. Amazon held here at the 50 that I had said that I thought was key. It rallied, but the high here, it's now in danger of making a lower high, just mid-range. It's sort of a little out of season for this. This is a little bit more of a play, I think, during like the holiday season or like the end of the summer for the holiday season. But I would say that Amazon here, in my opinion, there's really no edge. You're below the earnings gap high of a low of day. You're below there. You can see we kind of peaked into there and it rejected. So if you're below this earnings range here, I don't really see there's no real reason to be long. I did think that there was, like I said down here, I thought that there was a reason to buy for a bounce. We're getting that bounce. The bounce is a little bit weak. So first line in the sand, you've got to get above this 439, and then I think it really needs to clear this 452.65, which was the earnings high of day, for still higher prices. There is a channel. It's kind of roughly up there, so the highs might be incrementally higher. However, I am at some point looking for a move to this 484.73, which is the 1.618 Fibonacci extension. Maybe it just buys some time here and then, kind of gets it. We'll see. But Amazon, longer term bullish, short term a little bit more cautious. BABA. This one kind of closed. You can see it had the earnings gap play here. It got up to the downtrend and then just sort of sold off and now is kind of coming back. So I think that if BABA can clear this 89.29, there should be a move up to this 100 area to fill the gap. It's really taking its time here. It's just kind of closed on the back side of this, so I would really wait for the break before playing it. I'd be really careful with this stock, though. This stock has been under a lot of liquidation. I know a lot of funds have liquidated it. I don't know how much interest there will be to buy it back. And I know they have a really large lockup coming up in September, so I think that the goal here is for them to manipulate it higher so that they can unload some of these shares at still higher prices. I would do this defined risk, call spreads over common. If you want to do it with common, just buy some puts or put spreads as the hedge. I wouldn't do BABA naked. BIDU, it's been relatively weak. It's been just sniffing these lows. You can see it held here with a bit of a reversal. This low here is really key for me. If you lose these lows, these like 88s, 89, these high 80, like 88.61, or even this low here, I would say you could even move it up now to this 89.20. If it loses that, I think there's going to be a significant level of weakness down to this channel low, which I've been really waiting for, and it hasn't given to me. Down roughly around, it had been 80s, but now it's like in the high 70s. I do think that this would be a good right or right out type of a long play for like a snap back to like the 91s or so. Really a lot of relative weakness again. It is trying to get itself together. Maybe there's a rally up to the channel high. So as long as it can hold into this area, I think you can kind of play it right or right out, but it's not a chart I really like. I don't really particularly love this weakness. So that's my view on Baidu. Facebook, if I can type properly, got the rally I had been looking for. You can see it held roughly around the measured move of 76.96. It's rallied up fairly strongly. It closed Thursday above the 50-day moving average, but I had said I thought between 80 and 82, and roughly we got up to 81, 85 was going to be a lot of resistance. The stock on Friday did wind up selling off. However, it did close above the 20-day. It closed below the 50, but it closed above the 20, and it's on the backside of this downtrend line. I would say be a little cautious if we start losing more of this gain. It already took back about half of it. As far as the candle, not the entire move, but of this candle. So I would say over this high, it probably has some legs a little bit higher, maybe to retest the old all-time high. Longer term, I think the stock is going to 100. It's just a matter of how it gets there. I do think it's going to need some news, and it's going to need some earnings, although it did get some good news with regard to publishing. A lot of companies now are going to use Facebook newsfeed for direct publication, which keeps people in the system, in the ecosystem, and allows them to, use to promote advertising. So that should be a net positive for Facebook's advertising. Twitter, really rather weak, really just kind of holding like the bottom of this channel lows, sort of rejecting. I have said for a while I think that there is some risk down to this 36.07 and 34.62 to retest the lows. But I do think that you could probably nibble a little bit of Twitter here if you understand that it's going to be dead money for a long time. You can see here it was dead money for a long time until earnings, and it has not been able to string together back-to-back good earnings. I think that's really what it needs to do before the street's going to adopt it and sort of give it its get-out-of-jail-free card. At some point, I expect the stock to get roughly back up to about 45, somewhere between 44 and 46, I've said. I don't know how it's going to do that, if it's going to be on news or earnings, or if it's going to have some type of a rally pre-earnings. But eventually, I think it gets there. It's just going to be a tough slog to get there, and it's going to be very choppy and messy, and I think there are better setups. LinkedIn, to continue the social media weakness, has been weak. It does have a 61.8 Fibonacci retracement coming in at 189.56. I sort of do believe that somewhere between here and the trend line, which is the currently around 68, is going to set up for a really great longer-term buy in the stock. It has been weak. I do think it's going to test the gap at some point. So if there is some type of another leg down, I'd be looking to buy or to sell puts into that move. But again, social media weak, and I've said it for a long time. Facebook, I think, is the only investable one longer term. That's the only one that's still up close to near the highs. IBM, still showing some relative strength. If this does fill the gap, that'll be very positive for the Dow and potentially an anchor to hold the market. I do think at some point it's going to fill up to this 82.05, considering Warren Buffett just upped his stake and owns more. But I'm not really a big chaser here, although I will say if you were long over anywhere over the 70.33 to 72.19, still healthy, I would stay long, and I would probably be a buyer on dips somewhere at this like 165, which was really the breakout of this range. If there's some type of a rollover here, I'd be looking for that 50-day moving average and 165 confluence for still higher. Up here, maybe there's some type of a right or right out short. Maybe sell some out of the money calls for some type of rollback. A lot of people on the stream had been asking me if Netflix was a short. I had said no, that I thought it was testing up near the highs and that it would probably resolve higher to test the 1.618 fib extension. And man, it did it, and it did it in style with more. There was some news on China that they're going to be doing something maybe with Jack Ma, and it gapped pretty hard on Friday. That being said, this has done a lot of this in gaps. It did use up a lot of the time here to work off some of the excess. My thinking is that Netflix may still go higher, but it's a really hard chase to first be buying now into this move after this huge run. I would be sooner a buyer on this on some type of weakness. You can see here the stochastics did roll over here and there was some type of a pullback. I don't necessarily know if you're going to get the channel low so easily, and if you do it, it might be more than with time than by price, but I do think that there'll be some move back into this area, into the mid-channel, which will roughly be close to the gap. People will probably be a little bit more nervous about the stock then, and you could do something like right or right out play in Netflix. But yeah, the pattern is still fairly bullish. Priceline, on the other hand, looking fairly bearish. It had a false breakout above the channel, a gap down below not only trend but the channel, and is just sort of like middling here in near the 50-day moving average. Longer term, I do think that this stock is destined for higher, but I don't really see anything in the pattern here unless you take out these highs for a move higher. If you do take out these highs and it sets up something like an inverse head and shoulders, which is also possible, the move there will be quite powerful and likely back up to the old highs, or at least close to them. In the meantime, there could be some more risk down to fill up down to maybe to these reference lows, or maybe a overshoot down to the 61.8 fib retracement down at 1,096.83. At that point, I might be interested in playing a little BTD for a bounce, but it would be a lower high. A lower low, which makes me a little bit anxious. So I do, like I had said, I'm sort of watching the channel here. I would really like to see a breakout over these highs to play it on momentum rather than trying to like pick the dip. That said, I would probably think that there's some reference support down in this area, and you probably can maybe sell some out of the money puts into it for some type of a bounce. I had played RCL along roughly around this area here. It went against me a little bit, although I did it with put sales. I had been under a little bit of pressure. I had sold the 65 puts, although I announced on the stream on Friday that I was closing those out for a fairly nice gain, and I had been discussing with some people who were fairly bullish on the stock that I thought it would get back to 75 at some point. It did. It went a little bit lower, but it did get back there. So I'm out of that. If you're still long, just be careful. It's got the 50-day moving average above it, and also the start of the gap. There might be some type of a rollback here before a move higher, or this, if oil prices do continue to rise, this might have topped and it could roll over quite substantially. So I'd be really careful in those cruise lines. Tesla, still pretty bullish. I've said I've been looking for it to have the gap fill at 257.70. This is the season for Tesla. Remember, last summer was when that epic run happened where it got close to 300. So I do think Tesla is back on the buy the dips list, particularly if oil is rising. This will be a good proxy. I guess electric cars get a little bit more attractive when oil prices and gas prices rise. That said, we are coming into some resistance area up here. I would be looking to take some profits and probably reload on some type of a dip down to like close to like 240 or even into the somewhere into the 230s. If there was some type of a pullback move, the 200-day is as good as any as a reference point for a right or right out trade. Tesla, though, bullish for buy the dips. Visa is another one I've been talking about on the stream recently that I see it being bullish. You could see it's in a channel, and it's had a lot of tests up here at like the 69, 66 area. It did punch through here, but I think was held back by options expiration. So I did this with the call spread. I bought the 70-75 call spread. I paid like a little over $1, and I am 100% fine if I lose if I lose that dollar. That to me is fine. I did it really small. The intention was just to sort of have a little bit of long exposure. And if I were going to play in common, my downside would have been about $1. So I still have a lot of days until the end of June for this to play out. If it does roll over, I do think that there is a right or right out play down in the 66s, which is also a gap fill, the 50-day moving average, the channel, and the 61.8 Fibonacci retracement. So if this does something like roll over, I'd probably be aggressive here and buy with shares for a type of a right or right out play. If it snapped, I might flip short for a move down to the 64s. But I do think that this area would be really good support, and maybe after that it then takes off because it would be the 1, 2, 3, 4, 5 or 5th or 6th attempt at that point. I would think that it should be fairly strong. MasterCard, also another one, rather strong, just kind of riding this upper wedge higher, looking like it wants still higher. I'm not playing MasterCard, I'm playing Visa, but also this looks bullish. And American Express actually finally starting to try to catch some legs. It's looking like it's sort of filled up to here and looks like it may have a little bit more room to go. It's sort of like trying to find maybe a bit of a rounded bottom. I do think that the Visa and the MasterCard patterns are better, but this may have some room up to, I do think at some point it will eventually fill the gap to 86. I don't know when, but it's looking like it may. It's starting to look a bit better. If this does something like roll over here, then, just stay away. Like I said, I think Visa and MasterCard look better. Anyhow, that's my story, and I'm sticking to it. Be sure to follow me on Twitter. My handle is @JustinPulitzer. And if you like this video, please hit the thumbs up. It helps. Also, leave me some comments. Much appreciated. And let's have a great trading week, and cheers.